Now, inflation in the United States is still above the Federal Reserve's target of 2%, but it's been improving, moving gradually towards that target in recent months. Fed Chair Jerome Powell says more good data could strengthen the case for the central bank to start cutting rates. Powell compared the lack of progress towards that 2% inflation objective in the first months of the year to recent improvements that have helped to build the Fed's confidence that price pressures will continue to ease. The Fed is also now concerned about risks to the job market and the wider economy if rates remain too high for too long. A jobs report out last week Friday pointed to a still solid 206,000 jobs being added in the month of June, but with a slowing monthly trend and a rising unemployment rate that now stands at 4.1%.
Inflation has eased notably over the past couple of years, but remains above the Federal Open Market Committee's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.6% over the 12 months ending in May. Core PCE prices, which exclude the volatile food and energy categories, also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored. We need just to see more good inflation data. That's all. We had 7 months of good inflation data at the end of last year. Then we had a quarter, really a month or so, where inflation went up, and now we had one really good inflation reading and one pretty good one. We just need to see more so that confidence rises. I'm going to try to avoid sending any really specific signals about time today because it's going to depend on the data. It also matters what's going on in the labor market, though. We've also said that if the labor market weakens unexpectedly, that could be a case for loosening policy as well. Really, we're weighing both those factors.
Let's bring in Karina Mitchell. She's joining us now from New York with more data on this story. So, Karina, Jerome was with legislators for quite a few hours earlier today. What stood out for you so far in his engagement, especially with American senators?
Yeah, well, there were several key takeaways, Rama. But first, let's take a quick look at how markets are reacting to what Powell had to say, because we started our session here in the U.S. with the NASDAQ and S&P at record highs, and he just ended up speaking about 90 minutes ago. So I want to take a quick look at where markets are right now. Basically, the Dow is off session lows. The S&P and NASDAQ both in positive territory, up by more than 0.1%. So still on track for another record-setting close today. So the reaction has been positive on that side. But investors and senators, both very interested in what Powell had to say addressing the Senate Banking Committee today, particularly on rate cuts and when they might come. Powell was incredibly measured with what he had to say, and he started off by talking about the state of the economy right now before moving on to monetary policy. And he did say the labor market is still resilient. He said unemployment is low at 4.1%. We just got that data last week. But then he said that GDP growth in the first half is starting to moderate. And he made this key statement. He said, quote, cutting too little too late could unduly weaken the economy. That was a huge statement for him to make to investors and to senators who are dealing with an election year. They have constituents back home that are crying because the cost of living is too high. Shelter costs are up. Food prices still cost too much. Insurance costs are still very high, even though inflation has started to come down. So that was a very important comment. Other key takeaways, the migrant issue in the U.S. came up, particularly tied to the labor market and what it's doing. And Powell said it's really not having any sort of negative impact on labor. In fact, it's helping balance supply and demand, and it's loosening the labor market, which is helping drive down inflation. The other topic that kept coming up between senators when they were posing questions was housing affordability, because mortgage rates are so elevated at the moment. And there, Powell said there's, quote, significant housing issues in this country. As I say, 30-year fixed mortgage rate hovering around 7%. People are finding it difficult to buy. It's difficult to replace what they have. Home affordability is still a key issue. It's keeping people out of buying homes. There is slightly more inventory, but people are feeling very stretched. That's driving up rental prices as well. Rama.
Indeed. And I want to pick up on something that he said repeatedly, saying that, quote, more good data would essentially help to firm up the view on whether or not inflation is going to durably stay at or below 2%. But I guess the bigger question that everyone's going to be asking is what more data does the Fed need to see in order to essentially say, okay, we've hit our target, now we can start cutting?
Well, that's a fantastic question because they keep saying they're data driven and they keep saying they're looking for more data. In fact, he said more good data would boost confidence. That inflation is moving towards that 2% target. He may just get a shot of confidence in the arm because we're getting more inflation data this week. CPI for June, the consumer price index, will come out, estimated to come in at 3.1%, down from 3.3%. The next day we'll get PPI, and then the following week we'll get retail sales data, all ahead of its next meeting, which comes at the very end of July. Now, the Fed is projecting just one rate cut this year, 25 basis points, but markets are increasingly betting that there will be 2 rate cuts. The first will come in September. One thing to leave you with, Rama, is that Powell did say the next move in the rate will not be one that makes it any higher. So something positive to take away there.
Indeed, let's see how this plays out, because it certainly has an impact on the rest of us out here in the rest of the world. If the Fed cuts, hopefully that starts to lower credit costs for the rest of us out here in marginal markets. Karina Mitchell joining us there live from New York.